Over the course of history, people transitioned to better and better money that was scarcer, divisible, and portable. Eventually, they arrived at precious metals and finally gold. But it didn't stop with gold. Next came paper money, which is even more portable. In 1944, the so-called Bretton Woods system was created. The US dollar was chosen as the world reserve currency and it was backed by gold. 1 ounce of gold was worth 35 US dollars. The US dollar acted as a gold certificate, which means it could be exchanged back into gold. Other countries fixed their currencies to the US dollar. This meant that all currencies were essentially backed by gold. To avoid the logistics of transporting physical gold around the globe, when countries exchanged their currencies for gold, it was usually stored safely in the US. By 1966, countries became concerned that the US was spending more money than they had gold reserves. So countries started exchanging their dollars for gold. To prevent this outflow of gold from the US vaults, on August 15, 1971, US President Richard Nixon announced an emergency suspension of the gold convertibility system.
I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
By severing the link between gold and the US dollar, President Nixon created a system where all currencies were backed by nothing except government promises. This is known as a fiat currency. Without a fixed link to gold, the government is able to borrow and spend as much as it wants. When the government needs money, it borrows from the Federal Reserve. The Federal Reserve prints the currency required for the loan out of thin air and receives an IOU from the government in return. These IOUs are called government bonds. With the money provided from these loans or bonds, the government pays its bills and obligations. The bonds are sold on the market. However, the government needs more currency than it has borrowed to pay back the loans with interest. So where do they get that currency? The answer is, they have to borrow more. In order for the economy to function, the government has to borrow more and more money from the rest of the world. The more money the lenders loan to the government today, the more money they have to loan to the government in the future. And if they ever stop loaning, the whole thing collapses and they can't be paid back. This is a vicious cycle which can never be paid off, and it always requires you to go deeper into debt. With the creation of all this new currency, its purchasing power declines, also known as inflation. For a business to stay profitable, it either has to increase its prices or compromise on quality. As people realize that hoarding fiat currency is a loss, they buy more stuff than they need because they won't be able to afford as much for the same amount of currency in the future. This leads to a wasteful exploitation of natural resources and hinders sustainable development. Financial indebtedness thus leads to ecological indebtedness to nature. The US currently has big trade deficits, which means that they import significantly more goods than they export. Under the gold standard, countries with a trade deficit would pay trade surplus countries in gold to compensate them for the exchange of goods. This is the balancing mechanism of a gold standard. Had the Bretton Woods system been kept in place, the ability of the United States to issue an astronomical amount of US dollars and government bonds as a substitute for gold on the world market would have been severely limited, and US trade would have been far more balanced. For the United States, leaving the gold standard meant that trade gaps never had to be closed, resulting in persistent, large, and growing trade deficits in the United States. If the US can buy goods on the world market simply by printing money or issuing debt, persistent trade deficits are inevitable. The US last ran a trade surplus in 1975. Ever since the world has been operating on a fiat monetary system, Many countries have been running trade deficits and surpluses. The country that issues a reserve currency that foreign countries want to hold must be willing to supply the world with an additional supply of its currency to meet global demand. In case of the US, the liquidity needed for global trade is only possible through the release of additional US dollars. However, this creates trade deficits for the US. This problem is called the Triffin dilemma. By purchasing goods overseas for a long enough period, a lot of domestic jobs are eliminated and US companies lose the expertise and even factories to make those products. Thus, exports cannot recover and the country has to rely even more on imports from other countries. Imports make a country dependent on the political and economic power of other countries. It's dangerous to rely on foreign power to feed the population and keep the factories running. Inflation is a big driver for inequality through the so-called Cantillon Effect. It works as follows. Banks and financial institutions receive newly printed money first. This means they can buy services and assets while the prices are still low and not affected by the new inflation because the new money has not yet circulated on the market. Next, large companies benefit. And finally, the printed money reaches their middle and lower classes, which don't benefit from inflation at all, but only have to cope with higher consumer prices. As a result, the wealth gap between the rich and the poor widens. But governments don't just create money from thin air all alone. You play a key role in the magic money machine. When you put currency into a bank account, the bank only holds a small fraction, which is defined by the reserve requirement, and loans the rest out to the other customers. Here's an example. Your bank account shows $100, but the bank only holds $3 and loans $97 to Bob to buy something. The bank's computers show that you still have $100 in your account, but Bob's account now has $97 of new virtual money, backed by nothing except his promise to pay it back. This is new money created as debt. When those $97 are spent, the recipient deposits those $97 into another bank, and it is lent out over and over again. And each of these people have numbers in their account showing that they own this money. In other words, your original $100 has multiplied. This process of loaning out far more money than the bank actually has available as cash is called fractional reserve banking. But since March 26, 2020, the reserve requirement of the US Federal Reserve was lowered to 0%, which means that an unlimited amount of US dollars can be created. Almost none of the money in your bank account actually exists. This interference of governments and central banks in the economy is one of the reasons for the bad reputation of capitalism. The ability of state institutions to create money opens up an easy way to finance wars. Costly warfare is no longer limited by a finite supply of money. So to get out of this mess, we need money that cannot be controlled by a central entity. Imagine a technological innovation that allows anyone in the world to use money that is not controlled by a central bank and does not rely on an intermediary such as a bank or a payment provider. That innovation is called Bitcoin. An open, public, permissionless, borderless, neutral, decentralized, censorship-resistant, immutable money secured by the mathematical rules of cryptography. Bitcoin has the good qualities of gold as money and improves upon them. Let's compare the two. The properties of good money are scarcity. Just like gold, Bitcoins are scarce, with the difference that the total supply of gold is unknown. Bitcoin, on the other hand, has a maximum supply of 21 million coins. There will never be more than that. You can also calculate the exact amount of Bitcoins that will exist at any point in the future. Durability. Gold has proven to be very durable. Bitcoins reside in an immutable distributed ledger maintained by a global network of users. Since the network does not have a single point of failure, it is extremely resistant to attacks. Portability. Moving large sums of gold often involves a lot of effort and is very expensive. Large sums of Bitcoins can be sent quickly and at low cost to someone on the other side of the world. Divisibility. Gold can be divided by melting it. A Bitcoin can be divided to the 8th decimal place. That unit is called a Satoshi. So one Bitcoin consists of 100 million Satoshis. Fungibility. Gold is not always fungible, as there can be different variations with different degrees of purity or counterfeits. Bitcoin, on the other hand, is very fungible. Each Bitcoin is worth exactly the same as another Bitcoin. And recognizability. Gold is not easy to recognize. You need special equipment to find out if your gold is pure. The authenticity of a Bitcoin can be easily verified without having to trust anyone. Alright, but how exactly does Bitcoin work? It should be said that you don't necessarily need to know how Bitcoin works in order to use it. Nevertheless, understanding Bitcoin on a technical level gives you confidence that it actually works. Bitcoin is a distributed peer-to-peer network. As such, there is no central server. Each participant in the network owns a copy of the complete history of all transactions, divided into blocks that together form a chain, the blockchain. Each block references the previous one with a checksum called a hash. So if you were to make a change in one block, the hashes of all subsequent blocks would no longer be correct. So how are transactions added to the blockchain? When someone wants to send a certain amount of bitcoins to someone else, they broadcast a transaction to the network. But hold on, wouldn't that allow anyone to spend someone else's coins? No. Here's why. Before broadcasting a transaction to the network, that transaction has to be signed with a private key, which is comparable to a password to your bitcoins. The one who knows that key is in possession of the coins. Using asymmetric cryptography, the sender signs the transaction with their private key, creating a signature. The signature is then included in the transaction along with the public key. This way, the network participants can verify that the transaction is valid without knowing the private key. Once the transaction has been broadcasted to the network participants verify if the transaction is valid and add it to their memory pool, or mempool. Here, the transaction is waiting to get bundled into a block and added to the blockchain. This state of a transaction is called unconfirmed. This is where the process that makes the whole thing secure comes into play. Bitcoin mining. Bitcoin mining involves all the miners in the world trying to find the next block in the blockchain with their computing power. However, the hash of the block, which is actually just a number, must be smaller than a certain threshold. How small this threshold must be is determined by the so-called difficulty. The difficulty is a number that is adjusted by the network participants every 2 weeks, depending on the total computing power that exists in the network, so that on average, a valid block is found every 10 minutes. If someone finds a valid block hash by changing a random number in the new block or reordering transactions, they broadcast the block to the network, and all network participants distribute it among themselves and include the block in their blockchain. According to the rules, the miner who has found this block is entitled to a reward. This creates an incentive to secure the network. It also makes attacks on Bitcoin astronomically difficult, as an attacker who wants to change past blocks would need more computing power than the entire rest of the network. But where does the mining reward come from? It is partly funded by transaction fees and partly by the so-called block subsidy, which are newly created Bitcoins. Wait a minute. Didn't I say earlier that the maximum supply of Bitcoin is at 21 million coins? This still holds true because of an event that happens every 4 years, called Bitcoin halving. When this occurs, the block subsidy is cut in half. This way, the rate of newly created Bitcoins gets lower and lower, eventually stopping at 21 million. There will never be more than 21 million Bitcoins. Alright, but is it really necessary to save a small transaction, like buying a coffee, forever on the blockchain? No, the blockchain is not supposed to be used for micropayments. Instead, we can use a second layer, based on top of Bitcoin. For example, the Lightning Network. By using this network of payment channels, anyone can send small payments within a fraction of a second for almost zero cost, and in some cases even entirely for free. It works like this. When I want to open a Lightning channel to someone else with a liquidity of 1 million Satoshis, those satoshis get locked in the blockchain and subsequently unlocked in the Lightning Network. So whenever I want to buy a coffee, I can just route the payment through the different peers until it reaches the coffee shop. Once I close a channel, the remaining funds I have in that channel will get unlocked for me in the blockchain. Bitcoin provides access to a monetary system to people in developing countries who don't have a bank account, or people living in countries where the national currency has been destroyed by central banks. Bitcoin mining can be done anywhere in the world. Since miners' profits depend on the cost of electricity, they have an incentive to use renewable energy and stranded energy, such as natural gas electricity in remote regions that has no buyers, and thus would otherwise be wasted. To avoid venting the gas into the atmosphere, it is flared. Bitcoin miners can use this excess energy, which would otherwise go unused, to secure the Bitcoin network. When demand for energy drops off, or when intermittent energy sources exist, mining hardware can be turned on to be the energy buyer of last resort. This realignment of incentives also means that green energy companies that normally cannot scale and suffer from intermittent energy sources can still profit and compete with fossil fuel-based energy producers. To conclude, Bitcoin is an evolution of money. Bitcoin is not controlled by central banks, it is completely decentralized. It allows anyone to participate in the financial system and is resistant to censorship. Bitcoin is not prone to inflation, as the maximum supply is and always will be 21 million. Due to its non-inflationary nature, people will think twice before wasting their money on useless junk they don't need. People and businesses will actually have reserves for potential crisis, as there will again be an incentive to save. I hope I was able to familiarize you a little with the subject of Bitcoin. Thank you for watching.